Welcome to the JWell CFO show, where we help creative firm owners understand and improve their financial management. Are you tired of feeling like you're constantly playing financial whack-a-mole? Are you ready to take control of your money and make it work for you instead of stressing you out? Well, you're not alone, and I have good news for you. Hi, I'm Jeremy Wells, CPA, and I've worked with many creative entrepreneurs who struggle with managing their cash flow and wonder why it's so important and why it's so difficult to manage cash flow. So, in this episode, I'm diving into the world of cash flow management. This is the first level of the financial management pyramid that I've talked about on a previous episode. So, we're going to explore why cash flow is the first priority, why I make it that first level of the financial management pyramid, why it's critical and the first priority for a creative firm owner, and how a basic accounting system can help you manage it effectively. So, put down your credit card and join me for some practical tips and insights on how to manage your cash flow like a pro. First of all, what is cash flow? What do I mean by that, and why is it important? Cash flow is the lifeblood of any business. Just like if a human being had a problem with their blood flow, that human being would probably have some health problems and might even be at risk of dying. The same thing is true of a business. If a business does not have healthy cash flow, then that business is going to have problems, and that company might actually be facing bankruptcy and probably closure if it can't fix those cash flow issues. So it's especially important for a creative firm that faces some unpredictable income and expenses to make sure that cash flow management is happening and that cash flow is being managed properly inside the business. Cash flow is the movement of money, cash, into and out of your business. It's when cash comes in and cash goes out. And we're looking at the net when we talk about cash flow. So cash flow over a certain period of time, usually a week, a month, a quarter, maybe a year, how much cash has come into the business, how much cash has gone out. Now, that movement of cash can come from a few different sources, and it can go to a few different places. So cash can come into a business from sales, it can come in from investment, it can come in from financing or debt, and then it can go out for expenses or other types of payments that go out of the business, such as repaying debt or distributing cash to owners and investors. When we're talking about cash flow, we're talking about deposits as cash in and expenditures as cash out. Deposits are different from revenue. Revenue is income from sales. When you sell a product or a service to a customer of yours, and you either are scheduled to be paid, meaning you've sent the invoice, now you're waiting for payment, or when you actually collect the cash for that payment, that is recorded as revenue. And it depends on whether you're using cash or accrual basis for your books, but in general, either you're waiting to collect a payment or you've actually collected that payment. We call that revenue. That's only from sales, but there are other ways your business can bring in cash. There are other sources that would cause deposits of cash to come into your business. Either you as an owner have contributed cash into the business, or the business has taken out a line of credit or a loan, and therefore cash comes into the business. And there are a couple other ways that cash could come into the business, but in particular, we're looking at revenue, investment, and debt as the sources of cash inflows for the business. When we talk about cash going out or expenditures, we're not only talking about expenses. Paying expenses with cash is one way that cash can go out of the business, but there are other expenditures too, which also includes paying off debt or distributing cash to owners. So some of the same ways that money can come into the business, such as investments or debt, money can also go out of the business, distributions to owners or repaying debt. Expenditures include expenses, but also other ways that cash can flow out of the business. So it's important to manage and track your cash flow. because there are a lot of ways that cash can come in and go out of the business that are not included in profitability. And in fact, one thing that I often have to remind customers of mine is that profits do not pay bills. I want you to run a profitable business, but before that, I want you to run a cash flowing business because profits don't pay bills, cash does. Profit doesn't pay salaries, cash does. Profit doesn't pay distributions to owners, cash does. Cash flow determines your ability to pay your bills, to invest in your business, and to meet your financial goals. Profitability helps with that, and generally profitable businesses tend to have better cash flow, but there's no guarantee. In fact, you can have profitable businesses also be cash poor. I've even seen profitable businesses struggle to the point to where they have to go out of business because there was a lack of cash to sustain operations. Now, how could that happen? Well, a couple different ways. One, you might have too much debt, and therefore the payments on the principal of that debt, which don't affect profitability but do affect cash flow, overwhelm the ability of the business to raise funds. That's one way. Another way is owners might take too much cash out of the business for their personal use. So even though the business is profitable, it's not profitable enough to sustain the owner's lifestyle. And so the owner is drawing too much cash out of the business, which is making the business unable to pay its bills, pay down its debts, and therefore the business goes broke, trying to keep up with the owner's personal lifestyle. That's a pretty common one that I've seen in small businesses as well. If your business does not have enough cash, then it's either going to have to borrow, which is going to kick the can down the road. Today's cash flow problem is just going to be exacerbated into tomorrow's cash flow problem because now, not only does the business not have the cash to meet its demands today, but you're putting extra stress on that by having to service that debt in the future. Your business might also have to sacrifice growth opportunities. If your business doesn't have cash flow to afford another employee's salary, then you might not be able to hire that next employee, which means you can't expand the service offerings of your business, or you can't expand the client roster of your business, meaning you couldn't take on a new customer that might be a key customer for your business. These are all ways that cash flow problems can exacerbate and turn into bigger problems down the road. You can have a snowball effect with cash flow problems. Another way that cash flow problems can cause bigger problems for the business is when you have fraud or embezzlement. So if you have employees and those employees have access to business funds or business assets, then you open up the potential for fraud or misuse of those assets. And those could cause cash flow problems that wouldn't necessarily be seen on a profit and loss statement. You might not even notice them, even looking at the bank account, even looking at bank statements. But if we're tracking cash flow and we can see where excess cash outflows are occurring, it might help catch or even possibly prevent some expensive fraud or misuse of assets in your business. Now, on the other hand, it's possible to have too much cash in your business. Now, this is a relatively good problem to have, but it's still a problem. We don't want your business to be too cash rich because then we're putting cash into a business that would be better used elsewhere. Either that cash needs to be reinvested into the business, meaning you need to use that to hire some employees or to make some extra payments down on debt, or if there's no debt, give some distributions to the owners. The owners can then go use those funds in other kinds of investments or cash flow generating activities. For example, if your business is fairly rich on cash, you might want to look as the owner taking some of that cash out and investing it into a retirement plan or investing it into some real estate properties. That way, you're deploying cash in ways that will generate cash flow and profits elsewhere. Because if the business is hoarding cash and it doesn't necessarily need it for its own operations, then you've got a lot of cash sitting there that's not working for you. And in fact, with inflation, anytime cash is sitting in a bank account, even an interest bearing bank account, that cash is actually losing value. There are almost no savings accounts that will pay interest rates equal to what the current inflation rate is. And that's true regardless of what inflation rate is. If inflation is 2 or 3% versus what it's been lately, where it's 6, 7, 8%, you're usually looking at savings accounts paying interest rates of a quarter to maybe a third or a half of what inflation is, which means even though you're making some money in terms of interest, you're still losing money in terms of the purchasing power, the value of those dollars over time. So you're better off deploying that cash in ways that are going to generate cash flow or build up in value over time and grow at a rate faster than inflation, because that's not going to happen with that cash sitting in your business checking account. So managing your cash flow means balancing inflows and outflows of cash to meet your needs and objectives. That's what we're ultimately trying to do with cash flow management. Make sure that you're deploying the business's cash and managing its cash flow as well as possible in pursuit of your personal vision. And your vision is something that I've talked about in a prior episode. So go back and listen to that if this is the first time you've heard me talk about that. But ultimately, what we're trying to do is get your business to fund your personal vision, at least the financial aspect of your personal vision. So how do we deploy the business's cash flow in a way that best does that? It might be reinvesting that cash into the business. It might be taking that cash out in the form of distributions and deploying it elsewhere, deploying it in the stock market, into rental real estate, maybe some other kinds of investments you're interested in. So that's ultimately our goal here. So why is cash flow not just a priority, but the priority for a creative firm owner such as yourself? Creative firms face unique challenges, and this is part of why I love working with them. We're not dealing with manufacturers that have a lot of overhead and a lot of inventory to manage, but that doesn't mean that creative firms don't face their own challenges. One of them is irregular income, and this depends on your service offering, your pricing methodology, and your overall business model. But you might have income streams that I describe as lumpy. So if you have a lumpy income stream, that means if I tracked your total income, say per day or per week, over a period of 6 months or 12 months, then that line graph would bump up and down throughout the year. In other words, you're not bringing in a consistent level of income week over week or month over month, usually because you're being paid a commission or you're being paid per project. Sometimes you finish a project and you get paid for it, and that's a bump in revenue for that week or that month. But the next month you don't have a similarly priced project, and so income goes down for that month. Or maybe you sign up a new customer of yours and you have a big deposit that's due on sign up, but then it's going to be 3 months or 6 months before you finish that project. And so you go that period without collecting another payment from that customer until the project is finished. If you are a real estate agent, for example, and some of my customers are real estate agents, I consider them creative entrepreneurs as well. There's a lot of creativity that has to go into being a real estate agent, especially in terms of the marketing and the client relationships that they go through. But for real estate agents, they will sell a house and collect their commission from the sale of that property. And they might have one property every few months that they sell. But their commission on that property, if it's a highly valued property, if it's a relatively expensive transaction for that property, then they might only need one commission check every few months in order to have the kind of income that they want to sustain their lifestyle. And there's going to be less turnover in those kinds of properties, those $1 million+ properties. Their commission checks are going to be substantial enough to where it'll sustain them for a few months. So again, this is lumpy income streams, and a lot of creative firms, creative agencies, creative entrepreneurs have these sorts of lumpy income streams. Now, there are ways that we can try to smooth that out or flatten that out. For example, I like using subscription pricing model. And really, subscription is a business model more so than just a pricing model. But that's one way that you can attempt to flatten out the income stream in your business. And even if you're not entirely subscription based, maybe you offer a subscription service that goes alongside your typical project based revenue stream. And so you have a bit of a backstop of some regular subscription income, and then you supplement that with project based income over time. Another source of cash outflows is expenses. You might have some project based expenses if you have project based income. Again, you might have the deposit, the 50% deposit for that project come in, but then over the next 3 months, you don't have any more revenue coming in for that project, but you do have the expenses. Early on, you've got to assemble a team. Maybe you've got to hire a few contractors. Maybe you even have a substantial enough project, and this is the first time you've really offered and sold that service. So you go hire a new employee that is a specialist in doing some of the work involved in that project. So you've got a substantial outlay of cash now because of that project. You've also got the deposit that came in, but over the next 3 months or 6 months, depending on however long it's going to take you to deliver that project, you've got a substantial amount of expenses to cover and therefore pay the cash out for relative to how much income has come in for that project. Now, again, if you're taking a deposit and then you're waiting until project completion to collect the remainder of the income for that project, then you might be at the whim of whenever your customer is ready to pay. This is especially true if you're sending out invoices that your customer can pay whenever they want. Slow payments can cause cash flow problems. So especially if you're billing the entirety of the price of a project at the end of the project, and I really don't recommend that. I recommend at least getting a deposit for your project-based work and income. But if you're not billing until completion, then you're at the whim of that customer deciding when to pay you, or maybe even not being able to pay you when that project is completed. And then you've got a serious cash flow problem because you paid out all of the expenses. You've had to make the cash payments to your contractors, to your employees that entire time. And now you're waiting on the revenue to be collected. That can cause significant cash flow problems as well. So some of the solutions there are obviously getting paid upfront. If you can't get paid 100% upfront, at least 50%, trying to find a way to productize that service so that you can either make it a fixed fee and spread those payments out or employ a subscription model in your business. And then finally, personal needs are going to happen. So if you are an owner of a creative firm, especially if you're a solo owner, you might have cash in your business that you would rather be using for personal purposes. And so your business is going through a period where you're not expecting to need significant cash reserves in your business. And so the cash is just sitting there, but you've got some personal needs or wants for that cash. Maybe you've had a medical emergency pop up, or maybe it's time to upgrade some appliances or your vehicle or some major purchase in your life. And so you pull some cash out of the business to go fund that personal expense, which is all fine. But now you've drained your business's cash reserves. You've put the business in a slightly more precarious position when it comes to its own cash reserves. And then especially this time of year, because right now we're in January, so we're looking at taxes. And you're going to have to make some tax payments here coming up soon. These are all things that might pop up where you need cash for personal uses. And because, especially if you're dependent on your business for income and personal cash flow, you might need to raid the coffers of the business to get at some of that cash. And that's fine. It happens. But just understand that might put the business in a precarious position when it comes to cash flow. So as a creative firm owner, you have to be proactive, flexible, and resilient. And these are really the three terms that I use and that I frame cash flow management in terms of, that I'm trying to use to guide as principles how we think about cash flow management in my firm. We want to be proactive, flexible, and resilient in managing your cash flow to ensure that you have enough cash to cover your costs, your opportunities, and your needs. So we want to be proactive, flexible, and resilient, and we want to take into account costs, opportunities, and needs. And if we're doing that, if we have a plan in place to manage cash flow that handles all of those things, then we should be in a position to where your cash flow is taken care of in terms of that financial management pyramid, and we can start to look at the higher levels of that pyramid. So what do we need to have in place in order to manage cash flow effectively? You need a basic accounting system in place. A basic accounting system is a set of tools and practices that you use to record, classify, summarize, and report your financial transactions and performance. Now, most people hear all of that and they think, okay, cool, I just need a bookkeeping system. I just need QuickBooks, or even simpler than that, I just need some spreadsheets. And to a point, that's true. You can build an accounting system on spreadsheets. That's perfectly fine. I have some small business clients that they don't have that many transactions, and so all of their accounting for the year they can do inside of some spreadsheets. I have a lot of other customers that we need an actual accounting system in place, and so we're looking at something like QuickBooks Online, for example. So your accounting system is going to help you track your income and expenses. Those are primarily what we're looking at, but we're also looking at assets, liabilities, and equity. So these are the balance sheet items. Your income and expenses go on your profit and loss statement. Your assets, liabilities, and equity go on your balance sheet. And cash flow is the combination of the two. So there are going to be cash flow movements that don't occur on the profit and loss statement. We need to look at the balance sheet as well. And it's the interaction of those two statements is where we get at cash flow. A lot of business owners tend to only look at the profit and loss, and then they look at their bank statements and they don't understand why the profits don't equal the cash in the bank. Because there are a lot of transactions that happen in a business that aren't part of the profit and loss statement. They're not reported on the profit and loss statement. They're reported on the balance sheet, and therefore they affect cash flows, but not profitability. So that's what we're going for with a basic accounting system. We're trying to look at not just profitability, but also tracking cash flow. And really, the priority from the start is cash flow, because cash flow is the blood flow of your business. And without proper cash flow, without sufficient cash flow, your business is not going to make it. Now, this accounting system also helps you meet your legal and tax and regulatory requirements. Businesses are required to keep books. Now, it doesn't mean that they have to be physical books. They can be digital, they can be in software, but it also doesn't mean that it has to be expensive bookkeeping software. It can be spreadsheets. There just needs to be a system, and it needs to be clear what the rules and the principles of that system are. So this is easiest accomplished with an actual bookkeeping system in place, something like QuickBooks Online, but that's not necessary. Although it is necessary to have books, it is necessary to have some sort of accounting system in place for your business. You're also going to want to be able to communicate the financial performance and position of your business to third parties. So one of them obviously is tax agencies. So the Internal Revenue Service, the IRS, maybe your state tax agency are going to want to know how your business has performed. But there might also be other third parties. So if you have investors, sometimes creditors want to see how your business has performed. So if you're trying to get a business line of credit, or if you depend on the business for your income and you're trying to get a mortgage on a new house, for example, they'll want to see the financial reports from your business. And then also you might have partners in your business, and you might be the primary partner, or what we call the general partner, but you also need to be able to relay to your other partners or your limited partners how the business is performing. So the basic accounting system is going to include a few essential components. So first of all, I mentioned accounting principles. Now, there are some established accounting principles, and these are particularly used by big public companies, so Fortune 500 companies, we talk about US GAAP or generally accepted accounting principles. And for companies outside the US, we have international standards, but these are really the standards and the principles that big companies use. With small businesses, we have a lot more leeway, but we still have some generally accepted principles for accounting. And so we can fudge on them a little bit, but it's still important that we apply those principles so that the reports that we're producing based on your company's financial information fill some criteria and are presented in a format that makes sense to some of those third parties. So, for example, we want to be able to produce financial reports that would make sense to an IRS employee. We want to produce financial reports that would make sense to a lender working for a bank that you're applying for a line of credit or a mortgage. So even though we don't have to follow hard and fast principles that large public companies are subject to, we still need to follow some basically accepted principles that small businesses are usually held to as well. So we have the accounting principles. We also need the actual bookkeeping. We need to know the financial transactions that your business has performed, whether that is looking at your bank statements and your bank feed, or it might be things that happen that aren't necessarily captured in the actual bank feed. For example, when you send an invoice to a customer, we need to be able to record that as an accounts receivable, even though there's no bank transaction to go along with that yet. There won't be a bank transaction until you get paid. But now, the fact that you got paid, the payment itself is important to know, but we also need to know that that payment was a payment for an invoice that you sent out to that customer 2 weeks ago. So we need to be able to connect these different banking and non-banking financial transactions in your business together. And that's what a bookkeeping system helps us do. We can do this. Spreadsheets become unwieldy very quickly in a small business. And so we're usually looking at something a little more powerful that can bring all these different kinds of bank and non-bank transactions together. So something like QuickBooks Online, where you can do your invoicing, you can do your bill pay, you can do your payroll, but you can also pull in your bank feeds and have all your bank transactions as well. And you can match bank transactions to non-bank transactions. So when you collect payment on an invoice and you have that cash deposited into your bank account, we can match the payment deposit in your bank account to that invoice and mark the invoice as paid. And we can knock multiple birds out with one stone by using an integrated bookkeeping system. We're going to want to be able to produce financial statements. We're going to be able to give you a profit and loss statement, a balance sheet, a cash flow statement. Show those reports to your partner, show those reports to your lenders, show those reports to a tax agency if we need to. With spreadsheets, we might need some time and have to do some pretty intense work to be able to cobble together all of the information into a statement. With bookkeeping software such as QuickBooks, we can push a button and we can pull those statements fairly quickly. So when you're using a basic accounting system, when you've got one in place and when it's updated and it's maintained and you know what you're doing, you're applying those good accounting principles to your accounting system, then you get a few benefits from that. And the primary one here is that you can monitor your cash flow. You can see where your cash is going. Without an accounting system in place, the only way you know anything about cash is by opening up your bank account and looking at the current balance. The problem with that, though, is it doesn't tell you anything about your upcoming cash needs, right? So is the current cash balance sufficient to sustain operations for the next week, month, 3 months? Who knows? It doesn't tell you how much cash is going to be coming into the business. Do you have accounts receivable? Do you have invoices out there that you're still waiting to collect payment on? Do you have debt payments coming up? Again, this isn't going to be evident from your bank statements or even a profit and loss. If you were able to put together a profit and loss without an accounting system, it's not going to be evident how much cash your business is expecting to come in, how much cash your business is going to need over the next period of time, week or month. You're going to be able to control your expenses. You can classify your expenses by type or function within the business and then compare that to your expectations. If you have a budget, we can even look at benchmarks. And this gets a little advanced. It starts getting into profitability, but we can do that with an accounting system in place. We can at least have the data organized and together if we want to do some more advanced analysis here. You can also try to negotiate better terms or maybe look at alternative vendors if you know how much you're actually spending. A lot of owners are shocked when they see not just the profit and loss statement that's organized by category. So they might know how much they're spending on office expense, for example, for a total. How much money is going to office expense over the last month? Okay, there's a number. That number seems high. Why is it so high? Well, let's look at that office expense broken down by a vendor, broken down by the different providers that we're actually paying. And a lot of owners are often shocked by how much they're paying to their individual vendors. And they start asking questions like, well, can we pay them less? Can we get a discount because we've been working with them for a long time? Can we get better terms? This is especially true when it comes to merchant fees, for example. Usually a lot of businesses are paying 2.9% of any credit card income that they collect. Well, if you collect more or if you have been dealing with your payment processor for a while, it's possible to reach out to them and ask for a preferential rate. So maybe they can knock that down to 2.5%, maybe even 2%, depending on how much volume you do with them, how long you've been working with them. So there might be ways that we can break down these expense line items and look at them from a vendor standpoint and start pushing and asking questions about how we can bring those amounts down. Now, again, this is getting into profitability, but there are cash flow implications here. So if we can get that merchant services fee from 2.9% down to 2.5%, how much more profit and therefore how much more cash is that going to mean your business has month over month? And so these are the cash flow questions we can start asking once we have a proper accounting system in place that can give us this kind of information and allow us to do this kind of analysis. You can manage your debts and payments better if we're tracking this information. A lot of business owners that don't have an accounting system set up, they lose track of all the debt they have between having multiple credit cards and maybe taking out a line of credit, maybe having a business loan to get the business started. That's a lot of debt and therefore a lot of payments to service all of that debt. And maybe they lose track of that. Maybe they don't have a solid idea of what the cash flow needs month over month for the business are in order to service all of that debt. That's something that we can plan for and include in the cash flow analysis once we've got an accounting system. You also need to be setting money aside for taxes. Regardless of what kind of business structure and tax structure your business has, you as the owner are going to have to pay tax on the income of that business if that business is profitable. So are you converting some of that business's cash flow into either savings for taxes or estimated payments toward your tax bill? And these are cash flow needs that aren't going to affect the profitability of the business. Profitability of the business is going to affect the tax bill that you have due, but those taxes are not deductible by the business. So there's no reverse effect here. You having to make those tax payments isn't going to be reflected in the profitability of the business, but the profitability of the business is going to drive up the tax bill that you're going to have to pay. Something that is really interesting that having an accounting system in place lets us do is start looking at some financial ratios. And again, this starts getting into some more advanced profitability analysis, but we can do this from a purely cash flow perspective. So financial ratios help you compare related figures across your financial reports. A lot of financial ratios are trying to connect information on the profit and loss statement with information on the balance sheet. We want to know how changes in the profit and loss are affecting things on the balance sheet or vice versa. Now, a lot of financial ratios are just coming from the profit and loss statement, but a lot of them are connecting those two statements together. We're looking for relationships between those two statements, and we're also looking for trends over time. So a couple of cash flow specific ratios that we might look at are liquidity ratio. So how much cash and liquid assets does the business have? So how much cash does it have? How much in accounts receivable does it have that we're expecting to collect soon, relative to how much debt does the business owe? And so that's a purely balance sheet question. How much cash does the business have? And how much short-term debt does the business owe? And that gives us a liquidity ratio. Is the business liquid? Can it afford to pay off its debt over the next couple of months? Another one might be your cash flow margin. I've talked about profit margin on the show before, and this is something that I'll circle back to in a future episode on profitability. But before we get to profitability, we need to think about cash flow margin. So your cash flow margin is the ratio between sales revenue. So how much revenue is your business actually bringing in from its customers? And then we're dividing that by cash flow. We want that to be as close to 1 as possible. We want as much of our cash flow to be coming from sales, but it's not necessarily going to be 1. In fact, if it were 1, that means we would have 100% profitability. There'd be no cash going out of the business, and that can't happen. You have to pay money from your business in order to make money to cover expenses. But then at the same time, we have cash flow going out to owners. So it's definitely not going to be 1. It's going to be much lower than that. But in general, that's what we're looking for. And so we can do these kinds of analyses. And it's not necessarily that we want to hit a target, but we want to be moving in the right direction with these ratios. If you're relying on spreadsheets and looking at the bank balance every day on your phone or on your computer, you're not going to be able to do this kind of analysis to understand how your business is performing. And finally, the ultimate goal here with all of this is to improve the decision making. I want you making decisions in your business that get you closer to your personal vision, that get you closer to your financial goals and dreams. And you need to be making decisions in your business that are going to get you closer to that. You can get lucky, but you can't be making good decisions for long when you don't have proper information and data to help you make those decisions. You can use the financial information coming out of your accounting system to assess the business's financial health, to look at trends, to find opportunities, to identify risks, and make informed decisions. And then ultimately what you're going to want to do is get some guidance, get some help from a CFO or a financial advisor to help you understand and manage your business's cash flow and make sure that you're moving yourself toward the financial vision that you have for yourself. Cash flow is the first priority for a creative firm owner, really for any business, but especially for a creative firm owner, because it determines your ability to survive, grow, and thrive. And that's ultimately what I want for you. I want you to be able to thrive. A basic accounting system is critical, and it's going to help you manage your cash flow effectively by providing accurate, timely, and relevant financial information and tools, and allow you to do the kinds of analysis that I've talked about. Now, if you're not sure how to set up a basic accounting system, or if you've got one set up, but you're not sure how to run it, or you're getting too busy to be doing your own bookkeeping, then reach out to me and I would be glad to help advise you on that, support you on that, find somebody that can help you with that. I might be able to in my own firm, or if I can't, then I'll help you find somebody who can. Thank you for listening to the JWell CFO Show. I hope you found this episode helpful and informative. I hope you've gotten some value out of this episode. If you have any questions or comments, then please feel free to contact me. You can find me on Twitter at JWellCFO, or you can email me at jwells@jwellcfo.com. And please help me and leave a review on your favorite podcast platform and subscribe to the show if you haven't already. Until next time, take care and keep growing your creative firm.